The growing financial turbulence of the past several months represents a massive stress test for the global financial system, one that has become more pervasive and more worrisome in recent weeks. The financial crisis that started in a relatively small part of the U.S. financial system today has grown into a global challenge. A problem that seemed at first to be essentially financial in nature by now has evolved through the increasingly complex interlinkages between financial markets and the real economy into a threat to the sustained and stable global growth that has prevailed over the past 5 years. By now, there's little doubt that risks of further escalation of this crisis are rising, and decisive policy action will be required to put the global financial system and the global economy on a firmer footing. The first priority must be to reverse the spreading strains in global financial markets and to restore the normal functioning of the financial system in advanced economies. For public authorities, this will require making available adequate short-term liquidity while striking the right balance between market solutions and public sector intervention. The actions taken yesterday by several central banks are helpful as they reflect recognition of this critical need to assure market liquidity. With regard to actions of a more structural nature in the financial sector, steps are needed to make sure that banks are adequately capitalized, as well as to increase financial institutions' transparency and to improve their disclosure. Even as these financial policies take hold, the global economy, and advanced economies in particular, will continue to face pressures from tightening credit conditions. If so, there's likely to be a role in some countries for stepped-up counter-cyclical macroeconomic policy measures to help support demand. Already the U.S. authorities have enacted a temporary fiscal stimulus, while several central banks have eased their monetary policy stance. However, the steps announced already may not prove to be adequate if low probability but high impact events materialize that jeopardize global financial stability. The implication is straightforward. With cross-border economic and financial linkages having become both more potent and more complex, careful attention needs to be paid to contingent risks. Moreover, such risks need to be evaluated in a global context. In other words, policymakers as a matter of course need to think the unthinkable and to consider how they would plan to react if contingencies arise. The need to prepare systematically for potential risk has been demonstrated amply during the past few months. After all, the failure of both financial institutions and public authorities to anticipate the current challenges already damaged some core institutions, undermining confidence and weakening economic prospects. Moreover, to be effective in a globalized world, such contingencies and the potential remedies need to be addressed in a global context. For our part, the IMF is using our expertise to determine which countries might have space for countercyclical macroeconomic policies should these risks materialize. But even macroeconomic policies may not be enough, and we are also starting to think on a contingent basis about what other types of public sector intervention may be needed. We are also cooperating with other institutions, such as the Financial Stability Forum, in developing measures to help repair the financial system. The fund also stands ready to use its record liquidity, if needed, to help cushion the global economy. I will return to the issue of the fund's role at the conclusion of my remarks, but first I will address our diagnosis of the current challenges and then describe a three-pillar strategy for responding to them. As we all know too well, what was initially considered to be an isolated, but in fact widely anticipated weakening in the U.S. housing market spread unexpectedly across markets and economies. Of course, there's no question of returning to the unsustainable market conditions of early last year, when spreads and market volatility were exceptionally low by historical standards. Instead, we need to consider what new challenges might lie ahead and what actions might be required if new risks materialize. The potential transmission channels of these contingent risks reflect the reality of globally integrated economies. Financial macro linkages are at the core of this crisis. The two key sectors of the financial system, traditional banking activities and securities markets, have faltered simultaneously. there's been a spiraling loss of confidence in the risk management practices of some of the leading financial institutions and in some of the innovative products that they have created. Thus, certain sectors of the securities market have become virtually immobilized at the same time that several major banks are suffering large losses. This differs from past crisis episodes, where one of these two sectors usually was able to help compensate for weakness in the other. Moreover, monetary policy support typically proved to be highly effective in the past, as reductions in policy rates facilitated the normalization of credit conditions. At present, the effective intermediation of savings has been hampered, and there's a risk of a broader, more intense tightening in credit conditions, with potentially significant macroeconomic consequences, notwithstanding aggressive efforts by central banks. A world of financially integrated markets also implies more rapid and stronger spillovers across economies through traditional as well as novel channels. Spillovers through the traditional trade channel remains a central transmission mechanism of disturbances, even though global trade patterns have become more diversified. But financial spillovers have become more important. Moreover, the impact of such linkages can become progressively more pressing, as confidence and balance sheet effects can become relatively more serious as an initial disturbance grows in scale. In other words, the effects can be nonlinear. The high and rising correlation of global equity prices and the potential for sudden capital flow reversals imply that shocks at the core can be transmitted rapidly through the entire global financial system. Now, these are the potential transmission channels, but what are the main risks, the unthinkables, if you will, that might be considered today in thinking of contingency plans? Well, for one, the possible emergence of a global financial decelerator could amplify the impact of the financial turmoil on the real economy. A downward credit spiral driven by rising defaults or margin calls that force asset sales even as the value of collateral deteriorates could produce new rounds of deleveraging and asset price deflation. Such a development could have broad, even global consequences, especially since corporations and banks in many emerging economies have tapped international markets and may eventually prove to be vulnerable at wider risk spreads or could face a retrenchment in capital flows. Although the current distribution of risks to global growth appear to be skewed to the downside, the possibility also cannot be ignored that an upside risk exists as well. In particular, we can't simply ignore the possibility, given the uncertainties, that what now seems to represent appropriate fiscal stimulus and monetary policy easing would turn out to be overly aggressive, leading to excessive global liquidity growth and subsequent overheating. Unexpectedly strong domestic demand growth or supply constraints could result in further increases in energy or commodity prices, perhaps accelerating inflation pressures and deteriorating inflation expectations. In other words, we have to be ready to face risks on all sides. But in considering contingent risks, I can assure you that we have not lost sight of the risk posed by still large global imbalances. So far, a disorderly winding of these imbalances has been avoided, in that exchange rate movements, although they have raised understandable concerns, so far have been orderly in the sense that interest rate differentials have not moved perversely relative to exchange rate shifts, or perhaps the other way around, that exchange rate shifts have not been perverse relative to shifts in interest rate differentials between the major currencies. But the lack of movement in currencies of key surplus countries, notably in Asia, have added to concerns of potential stress in the future. Last year, the 5 participants in the fund's multilateral consultation on global imbalances, the effort to which Fred alluded to in his introduction, unveiled specific economic policy plans that were intended to help sustain global growth while reducing global imbalances. The fund has been monitoring progress on these policies in the context of its regular bilateral and multilateral surveillance activities. The consultation's participants acknowledged at that time that the inevitable international adjustment process would involve a slowing of domestic demand growth and a strengthening of net exports in the principal deficit countries, mainly the United States. That shift is now underway. The participants also recognized that if a global growth slowdown were to be avoided as this shift was occurring, there would have to be a quickening of domestic demand growth and a decline in the savings rate in those large economies running current account surpluses. However, there has been limited progress to date in implementing the policy plans promulgated at the time of the spring meetings in April 2007 by the participants of the consultations. Nonetheless, these policy plans retain their relevance. Now, against this background, a strategy to deal with these potential challenges could rest on three pillars: financial sector policies to stem the deterioration, macroeconomic policies to cushion demand, and a multilateral perspective and approach. The first of the three pillars involves acting to halt the deterioration of the financial sector and to restore its effectiveness. The overarching near-term goal has to be to rebuild confidence in the financial system. Having said that, the policies that we would consider to be appropriate in this context would also be helpful from a longer-term perspective, as they would increase the resilience and efficiency of the financial system. First, market liquidity needs to be maintained at a level that is sufficient to avoid pressures on economic activity. Thus far, the Fed, the ECB, and others have adopted innovative and appropriate strategies to contain the stresses in the interbank markets. Nonetheless, spreads remain uncomfortably high. Central banks, however, need to tread a careful line between providing liquidity flexibly and sowing seeds of future risk-taking through moral hazard. The way that liquidity risk is dealt with by banks and supervisors also should be re-examined. Banks should have incentives to sufficiently self-insure against adverse liquidity events, and supervisors need to refocus their attention on liquidity shocks, whether they arise from the way institutions fund themselves or from substantial commitments to off-balance sheet entities. Central banks, too, need to reassess their ability to provide liquidity. Their facilities should enable rapid provision to a broad range of counterparties, at a range of maturities, in multiple currencies, and against a wide set of collateral. The stigma attached to accessing existing standing facilities should be removed, and more generally, central banks should conduct a coordinated review of their liquidity arrangements to ensure a more harmonized approach. Second, disclosure must be improved, while efforts are stepped up to recapitalize troubled banks. Now is not the time to introduce regulatory changes that permit losses to be hidden. Indeed, banks need to improve their disclosure practices so investors and counterparties can better understand what assumptions and positions lie behind their balance sheets. Regulators should ensure that there are no incentives for banks to hide assets and liabilities off their balance sheets, and supervisors should take a hard look at the systemic consequences of how fair value accounting is working in practice. In particular, more timely disclosures by large institutions worldwide, wherever this is material, is needed. In combination with greater disclosure, weakened financial institutions need to replenish capital. Pressures on institutions to deleverage, including at banks that have suffered the greatest losses, need to be kept orderly. Contingency plans need to be considered in the case that balance sheet contraction by non-bank financial institutions create new pressures on bank balance sheets, but investors are not willing, as they have been up to now, to provide capital injections. Only by maintaining capital cushions can banks confidently resist pressures to reduce credit excessively, much less to undertake new lending. Well, while these financial sector policies that represent our first pillar are taking hold, the real economy may continue to be affected, particularly if banks cut back on lending while they rebuild their capital bases and securities markets remain under stress. Because of this, there is a role for a second pillar of macroeconomic policies to help cushion the blow from the turmoil. Monetary policy is the first line of defense, especially in advanced economies. Of course, monetary policy will become significantly more complicated if high commodity prices continue to put upward pressure on inflation and lead to a rise in inflation expectations. But for now, The Federal Reserve appropriately has taken aggressive action, and central banks in Canada and the United Kingdom also have reduced policy rates. The ECB, for its part, has kept rates on hold, but this reflects the differing condition in the European economies and markets. But of course, it could respond flexibly if downside risks to growth intensify and inflation risks decline. In the current environment, there is a risk that monetary policy will prove to be less effective than in past episodes. In the United States, for example, spreads on many consumer and corporate financial products, such as jumbo mortgages and higher risk corporate and consumer loans, remain stubbornly high, partly or in some cases fully offsetting the impact of lower policy rates. This is why the IMF has been making the case that countercyclical fiscal policy may also be needed. In the United States, where growth has slowed significantly, the temporary and targeted fiscal stimulus should help to support demand. Of course, the rest of the world will not be immune to the slowdown in the United States, especially if it becomes more serious. In these circumstances, contingency planning also is required. In this regard, we are advising our members to consider where they have room to adopt temporary fiscal measures if needed. We have analyzed which of our member countries possess fiscal space. Our preliminary assessment suggests that major advanced and emerging economies, accounting for 2/3 of global GDP, could allow automatic stabilizers to operate fully in the event of a deeper downturn, and that a smaller number, accounting for nearly 1/2 of global GDP, have already or would have fiscal room to implement discretionary stimulus if needed. The global nature of the challenges, underpinned by increased financial and economic integration, means that policy responses should be framed in a global context. Thus, multilateral consultation and policy consistency represents the third pillar of our approach. Such efforts are evident in several fora, but they need to be strengthened and made more effective. It's reasonable to ask whether this three-pillar approach fits into broader concerns about global imbalances. As I mentioned already, policies developed in the context of the multilateral consultation on global imbalances remain relevant, as are the consultation's twin goals of sustaining growth and supporting an orderly reduction in global imbalances. For this reason, any fiscal stimulus in the United States must be strictly temporary. Longer-term fiscal problems are too daunting to give up the progress that has been made in recent years. For some countries, a move to boost domestic demand would meet both the short-term objective of lifting global demand and the medium-term goal of reducing global imbalances. In China, for an example, a shift in the policy mix to allow for tighter monetary policy, supported by exchange rate appreciation, and looser fiscal policy with an appropriate emphasis on social safety net spending is sensible macroeconomic management for a country experiencing growing inflation pressures. Other countries, such as oil exporters in the Middle East, have already taken action to boost government spending, and the challenge now is to ensure that such spending is appropriately focused to avoid further pressures on inflation. But in today's world of contingent risks, macroeconomic policies may not be sufficient to cushion the blow if extreme events occur. We must keep all options on the table, including the potential use of public funds to safeguard the financial system. Now, I'm not advocating the use of taxpayer funds to aid individual institutions, but I fully recognize that an appropriate role for public sector intervention exists if market solutions appear to be insufficient. At the IMF, we are giving serious thought to what can be done if contingent risks materialize, and we are using our expertise and many years of experience in helping our member countries through crises to think about what policies might prove most effective. What is important is to ensure that considerations of moral hazard are balanced against the needs to safeguard the financial system and sustain the global economy. The issues that I have discussed today require global solutions. The IMF, with its global membership, multilateral perspective, and technical expertise, can help in developing such solutions. So how do I see the evolving role of the IMF? As I've emphasized today, the current turmoil underscores the need to identify contingent risks that could threaten global stability and to develop potential policy responses. The IMF is using expertise in analyzing global economic developments to help fill these needs. But what if these contingent risks begin to materialize? We should be clear. The fund is not the first line of defense. This lies with central banks, together with financial supervisors and regulators, whom we view as close partners. In fact, the fund is not even the second line of defense. This responsibility lies with fiscal authorities. However, we do possess a deep knowledge of our members' fiscal policies and situations and consult regularly with them as part of our normal surveillance activities. But there's also a third line of defense, which involves public intervention to safeguard the stability of the financial systems at times of extreme distress. This is not something that is done lightly, and I am not advocating a particular course of action. But a set of reasonable options may need to be considered if the contingent risks that I have just outlined do indeed materialize. Of course, the fund's Articles of Agreement charge us with a unique responsibility for sustaining global economic and financial stability and progress. My fund colleagues and I intend to meet our responsibilities by helping our members anticipate and deal effectively with today's difficult challenge and with those that might lie over the horizon. Thanks for your attention.
Okay. As I said before, John has indicated a willingness to address not only more in-depth questions about what he has said, but issues that he has not addressed that are in this broad category of the global perils of the moment. So the floor is open. We'll start with Bill Klein here in the front.
John, you emphasized transparency. Let me suggest a way of looking at things that might suggest, in some sense, a step backward toward earlier practices. Let me start with the 1980s. With the debt crisis, the major banks had about 150% of their capital out to the Latin countries. If we had had immediate mark-to-market, they would have all been bankrupt. That would not have helped very much. We have gone to the opposite extreme, where we have mark-to-market in a situation in which there is no market except a distressed market. That in order to obtain a sale, it has to be sold at something that is far less than is the expectation of what it could be realized if held to maturity. I wonder about the following kind of approach. Did you have the public sector in some sense help identify what these things are worth, identify certain classes of AAA or alternate A, etc., and then have mark-to-market over a phased-in period, something like 3 years? Because then the expectation would be that as things normalize, those market prices would go back up, and the severe cutback in the valuations would not be artificially realized. The alternative is a risk of a downward spiral of artificially low asset prices that then cause artificial losses, that make institutions look artificially close to bankruptcy, that frees up the access of credit to those institutions as a consequence. Now, we hear that this couldn't possibly be a good idea because Japan did this and had a decade of lost growth. Well, this would not be Japan. This would not be obfuscating, but this would be looking back at a phase-in of mark-to-market rather than instantaneous mark-to-market. I wonder if this kind of an approach makes any sense to you.
Thanks, Bill. The point you raise is a serious one, and one I alluded to in my remarks. That we want to avoid this, what I call the financial decelerator, that produces those that potentially could produce such a result. And I mentioned that we need to think closely about the implications of fair value accounting for the current circumstances. But that being said, it seems to me, and I think to my colleagues, that if the solution is simply one of foregoing or forbearance, regulatory forbearance, and saying we'll all kindly pretend that things on the balance sheet aren't what they're valued, and it seems to me that that alone is unlikely to be the most effective way to deal with the circumstances. It seems to me we need a broader approach than that if it comes to this. And I want to be clear, I'm not advocating that something needs to be done, particularly needs to be done today. We need to think about if problems become more intense, how would we approach this? And I suspect it would require a relatively broader and more innovative approach than we have used it in the past. Again, rather than discuss this in this detail or that detail, simply would say, it seems to me, simply saying, well, we don't have to value things on what they look like they're valued now because we don't think that's it's the right value, is unlikely by itself to represent an adequate solution for restoring confidence and ultimately and quickly restoring the functionality of the financial system.
Bob Davis from Wall Street Journal.
Two questions. I think I got the quote down right. You talked about the potential use of public funds to safeguard financial institutions, but you were making clear that you didn't mean bailouts. But I don't really understand what you do mean. So can you go into more detail about what you're talking about? And then on the fiscal side, you talked about, I think, countries with GDP of half the global GDP had room for discretionary spending. And I assume that means even if that takes a country that's in budget surplus to deficit, or it's in deficit that worsens the deficit.
Yeah, and just following up on that last point, John, you did name a couple of names in terms of specifics under that heading, but could you name any more that the fund thinks would be particularly appropriate to carry out your strategy and would be big enough to have some significant impact on the global outcome?
Well, these are, again, we're talking contingencies rather than suggestions for current policy. And it's clear what we're talking about is countries who have fiscal space, who's have room relative to their medium-term fiscal goals to adopt temporary countercyclical policies. Again, rather than let me beg off the naming names at this point. Yeah, I know. Sorry to disappoint you, but no. And again, since we're not talking about today, saying things should be done today, we'll see how things evolve. But the broad point is that we think that there is room for significant fiscal action if needed, that would in a way that would not jeopardize, that would be helpful and would not jeopardize medium-term goals.
John, maybe just to pursue that a second, if we could. I think you're making a very significant statement when you say you think that is not needed right now. You're putting that under the heading of contingency
Yes.
plan, not needed right now.
We're not.
Therefore, you're saying the outlook ain't so bad.
Right. Well, our base case scenario is what I'm talking about is contingencies in a situation in which there's substantial uncertainties. And so the message here is that there is a need to be systematic and thorough and coordinated about evaluating contingencies and thinking through what plans might be put into place. Our base case remains one of a slowdown in global growth, of some note, but one that still incorporates a very sluggish U.S. economy, some slowing in the rest of the industrial economies, and still relatively solid growth in emerging market countries. And in that, if that's the correct context, then of course the need for some of the stronger actions that I'm talking about, especially with regard to macro policy, may not be called on. Nonetheless, as I was suggesting, we need to be live to the risks, and to think in terms of contingencies, to think in terms of how would we know if these contingencies are merging, and what would we think to do about it, and try to think about it before and think about it in a multilaterally consistent way that would boost confidence and be effective.
But could you explain what you meant by potential use of public funds to safeguard financial institutions? That didn't sound like a bailout. What do you mean?
Well, I guess we could end, I suppose we'd end up having a discussion of what is a bailout and what's not a bailout. Probably, maybe I'm standing here wondering if I should have used that term. But what I had in mind is some rather indiscriminate provision of funding, public funding to financial institutions. What I'm saying is that this is something that has to be done, again, in a considered, balanced, and globally consistent context. In other words, what I'm advocating is that these are the kind of issues that should be dealt with and in advance, rather than in the midst of or developed in a more ad hoc way as problems build.
Not to be dense, but you are then saying that as a contingency, the IMF is recommending that countries think about whether they need to bail out financial institutions.
I wouldn't use the term bailout. I would say whether again, the term bailouts is very loaded. The idea, of course, is that it might be appropriate to think in terms of more direct support for the financial system in a way that would be effective and consistent. And what I think what I was clearly suggesting is we need to think in more innovative terms than we have in the past about how that might take place if it were needed.
Thank you. Most of the international spillover from the U.S. subprime crisis and its aftermath seems to have fallen on Europe. But I noticed last week that Nomura Securities had reported large losses on its portfolio. So I wanted to ask you, John, whether you're concerned about kind of spillover in Asia, whether we might be reading more about losses of Asian financial institutions in the U.S. market over the next couple of weeks. And secondly, if I may, I wanted to ask you to address the point that Fred raised at the outset, and that was the issue of IMF follow-through on the guidelines for enhanced surveillance of exchange rate policies of the members. Since you were so deeply involved in that, I thought you might take a minute or two to address how the fund is following through on this. And I asked this cognizant of the fact that the fund is working through the Article 4 bilateral consultations with China and expects to release something in the next several weeks.
Let me take your question by parts. First was, could we see spillovers in places that we haven't seen them so far? And the answer was, I think I was trying to indicate clearly that those risks have to be considered. One of the hallmarks of the current circumstances, or the recent turmoil, has been, as I stated or implied at least in my remarks, that the epicenter of the difficulties was quite widely recognized and anticipated. The weakening in the U.S. housing sector was long predicted and I think widely seen. What was unseen was the virulence and the extent of the financial interlinkages that have created impacts in places that were never anticipated, as I suggested, not anticipated by public authorities, not anticipated by market participants who hadn't seen the connections. So what I'm suggesting is if pressures increase in terms of either financial or real economic sources, we shouldn't be too sanguine about the potential implications and interlinkages and think in terms of what those avenues of connection might be, which I tried to suggest a few, and think in terms of countermeasures. So you asked, could this affect Asia? And the answer is, of course. Our basic assumption about the global economy is that the emerging market economies are going to prove more resilient to disturbances in the industrial economies or weakness in the industrial economies than in the past. And I think for reasons that are probably well known in a venue like this. They reflect the rather different current account circumstances, their accumulation of external assets, the dramatic increase in interlinked trade, et cetera, that ought to provide substantially more resilience. But this, once again, we need to think about if weakness continues and there's transmissions, what would we do? Now, you asked about the surveillance, what we call it the fund, the 2007 decision on bilateral surveillance, which is, well, it's appropriate at this time of the year. It's inside baseball, I think, to most folks, and so I won't bore you with the details. But suffice it to say, one of the key responsibilities of the fund, as laid out in its Articles of Agreement, is the surveillance over exchange rate policies. The so-called decision is, in effect, the directions that our legislature, our executive board, gives to us, the executive, to give us their instructions on how to interpret our Constitution in applying that admonition to exercise firm surveillance. So the decision itself, which is available, it's on the public record, is a rather complicated document and will be probably hard to interpret for the non-specialists. But I think it can be interpreted rather simply. Our members have told us, the management and staff of the IMF, that in each and every case of our consultations with member economies, we are to give our opinion about the adequacy of their exchange rate regime and the exchange rate level. And we are to do so in a candid and frank way, recognizing the limitations in that kind of analysis, that there's no agreement on revealed truth with regard to the correct exchange rate regime or the correct level. Nonetheless, our members have asked us to speak frankly, and even though it's possible, they won't agree. So we intend to do just that. I think it's a very positive and healthy development, a clear direction from our members to us, but again, it's one that has to be seen in this context. Neither our members nor us think that we have some magic formula that gives the unerring right answer. The issue is we should have a frank and candid discussion about these issues.
Okay, I want to come up front. Tom Pally and Mike Musa, Morris Goldstein. Then I'll go to the back.
John, let me ask you an easy question. But first, I'd like to take the opportunity of your being here to make a policy suggestion to you, something that I've advocated for a number of years, which is the idea of asset-based reserve requirements. We have relied on risk-based capital standards, and we've seen they're very pro-cyclical with a number of problems attached. Asset-based reserve requirements would apply to all financial intermediaries, and they would have to hold reserves on the basis of even risk-assessed assets, and that could be a useful way of thinking about a future regulatory system. Now, my question is, one of the problems with crises is you get caught up in crisis management without necessarily thinking deeper about what created this crisis and the reforms that can then make the system better along the road. And so when people think about crises now, it's very easy to think of, say, something happened in August 2007, and we've got a problem that we're trying to deal with now, unwinding this liquidity crisis and so on. But to me, I would track back further and say it's not really an exogenous shock in August 2007. It's the product of a business cycle that we experienced. And therefore, even during the good times, the problem was already there in the making. If you take that perspective, what, in your view, was the problem or the problems that gave rise to this breakdown in August 2007?
Although, if I could, breakdown may be a little overly dramatized. We're not, I wouldn't describe what we've had as a breakdown, but it certainly hasn't been trivial. And it has the potential to be something quite a bit more serious, which of course was the implicit message of my discussion here. With regard to your suggestion on reserve requirements and supervision in general, regulatory requirements, this is an area in which already, as you know, the Financial Stability Forum's working group, of which we're a member, is examining the lessons that can be learned from the recent turmoil. It's not over. The turmoil is not over. So it would be a little premature to say, here are the lessons, even though I think we can see some aspects of areas where there are real problems. And of course, it's, for example, it's common to hear that this is all thanks to Basel II and risk-based reserve requirements, and that creates an inherent procyclicality. Well, I think the answer is, would we have been better or less likely to have run into these problems under Basel I? And I said, well, I don't think so, because the place that was the epicenter wasn't using Basel II. But nonetheless, my response is certainly these are areas that that in the fullness of time deserve a thorough vetting. Now, with regard to, was this inevitable? An inevitable result of the business cycle, and I would say I certainly don't think so. That being said, the underlying premise of the multilateral consultations on global imbalances was that sustaining global growth at the it's easy to forget the context. 2003 to 2007, as I think everybody in this room knows, represented the fastest period, 5-year period of global growth in 40 years. And in terms of balance of GDP growth, was the best balance expansion in the post-war era. So it's not as if it was obvious that something was going desperately wrong. But what was clear was that this well-balanced global GDP growth was accompanied by record payments imbalances, which suggested it was not, there was more going on. And as we all know, that reflected the imbalance in growth rates of domestic demand. And it was also obvious that for this growth to be sustained and for stability to be maintained, there was going to inevitably be an adjustment process that I alluded to in my remarks. Surplus countries were going to have to rebalance the source of their growth away from that export growth and towards domestic demand growth. Deficit countries were going to have to do the reverse. And the idea was, what policies could we put in place to encourage the smooth adjustment of these imbalances and to boost confidence that policies were being carried out in a way to help support that. And as I suggested, certainly the challenges have turned out to be greater than we expected, but as I said in my remarks, that switch is underway under more threatening conditions than we would have liked. But it's still, I think, very possible to put in place the policy measures that were, after all, elaborated by the participants of the multilateral consultations. That's, for those who don't remember, the U.S., the Euro area acting as a single currency area, Japan, Saudi Arabia, and China. Go back and read on the IMF website the policy plans promulgated by each of those representatives, each of those participants, about what they thought they needed to do. Their statement that achieving the smooth adjustment was a shared responsibility and that these policies were both in the interest of each participant and globally consistent. So it's not as if there's no roadmap. And I believe that more forthright and aggressive following or implementation of these policies would have helped diminish the risks of these problems. That being said, it's also true that we've seen that there were flaws or fault lines in the financial system that were not evident even to the most knowledgeable participants. And these are the things that we're going to have to think about. But first things first, let's bring this to an end and this period of turmoil to an end and restore greater confidence in forward progress in the global economy.
Hi, John.
Hi.
I guess I have three concerns, and they relate to the task of the IMF to engage in rigorous truth-telling.
Ruthless truth-telling.
Ruthless truth-telling, and my suspicion that, as in the past, we are unlikely to see it on this occasion. And there's a question both of diagnosis of what is the underlying cause of the problem, and we had a few words on that, the question of what the right cure is in the near term, and then the problem of rehabilitation in the longer run. On the diagnosis, I think it's not simply that leading officials and private sector leaders in the financial sector didn't see the flaws. They explicitly denied that the flaws were there. We were told on many occasions that all of these modern derivative products, credit insurance, and so forth, they were making the financial system and the economic system more resilient to shocks. Well, that's what we used to call a laugher. That's, I think, a conclusion that would be very hard to justify on the basis of recent experience where we've seen a lot of these things blow up. And the question is, when we get to ruthless truth-telling, is the IMF and the Financial Stability Forum and the group of officials who put forward this line prepared to stand up and say, we made a mistake, that our lack of attention to these problems and our misunderstanding was indeed part of the difficulty. Now, immediate care of the problem. You said, well, we don't yet need to go to the taxpayer to call upon him to bail out financial institutions. Well, I personally expect to pay between $25,000 and $40,000 this year to bail out financial institutions. Because while the Federal Reserve has cut the federal funds rate, which is the price of credit, I supply the underlying liquidity, and the income that I'm earning on that liquidity is being cut by $25,000 to $40,000. So I'm making my contribution. And I resent the fact that the Federal Reserve is given the credit for the bailout when I'm, in fact, the one paying for it. And I would like to see rigorous truth-telling by the IMF recognize that fundamental fact, that cutting the price, the official policy rate, is not costless to everyone. Somebody is paying the cost of that, and somebody is benefiting because of the payments that are being made, and that should be identified. Then rehabilitation. You mentioned the three pillars. Whenever I hear about the three pillars, I always think of Basel II. Now, I don't believe Basel II is responsible for the current crisis because, in fact, Basel II hasn't really been launched yet. Yeah. In that sense, I regard it as worse than the Titanic. It sank even before its maiden voyage. But it would appear that regulation of banks on the basis of internal ratings and their internal credit and risk management strategies has taken a couple of torpedoes below the waterline. And so the question here in terms of ruthless truth-telling is, are we going to hear from the IMF and from the Financial Stability Forum that, well, Basel II we better take that one back to the drafting board before we attempt to bring it forward and consider what else might be needed, including possibly the mark-to-market rules and a number of other issues about how we should structure a capital standard.
Great. Well, first of all, thank you for that vote of confidence. And second, we do miss you. Really, we do. Let's take your 3 points briefly. Innovative products have failed, and we all failed to see it coming. And I would say, yeah, but not as categorically as you would put it. Why? Go back and look at the April 2007 Global Financial Stability Report, and you'll find a listing of all, this is our semi-annual publication, you will find a rather exhaustive listing of what we perceived as risks that could derive from what appeared to be the possible mispricing of risk in markets. And naturally, we didn't stand up and say, you can say we didn't see it coming. We couldn't predict the date, but at least we said, here are some things that need to be thought about. And as it turned out, not only did those risks materialize, they materialized in a way that is much more virulent than had been anticipated. I myself find that when I look at what some of our largest financial institutions were doing, even I, after 23 years on Wall Street, was left shaking my head saying, what were they thinking? And you can find, frankly, that not all institutions made the same errors. So it wasn't as if it was impossible to understand what was going on. Nonetheless, we do have to think about getting too flippant and in the process throwing the baby out with the bathwater. Every time there's been a major advance in the securitization of financial markets, there has been a stress test. And those stress tests have tended to be pretty ugly. 1994, when the Fed unexpectedly tightened interest rates and there were massive losses on mortgage trading desks on Wall Street, it was because traders hadn't noticed something now called convexity. They didn't really understand the implication of these interest rate options embedded in underlying mortgages, and hence were sitting thinking that they had hedged against eventualities and found the hedges didn't work and they were subject to billions of dollars of loss. But at the heart of that, of the creation of the mortgage-backed securities market in its original form, was the interest rate swap market that made this possible. That market survived the test, and today you don't think about it. It works just fine. In fact, the conventional mortgage-backed security market in the U.S. is the largest non-governmental bond market in the world, and it operates even today with great liquidity. And you don't think about the vulnerability of the interest rate swap market. It works just fine, but there were plenty of people telling you counterparty risk in that swap market were going to kill us all. 1998, the incident of long-term capital management, I think a widely misunderstood event. What underneath it was a stress test of the equity derivative market. That, in essence, the question posed to market makers at that time was, were they going to countenance a massive default in the equity derivative market, or were they going to finance a workout? They financed a workout, and the equity derivative market remains a bulwark of modern financial markets. Today, we're seeing the stress test of a family of credit transfer products that basically transfer or map changes in perceived credit quality to securities prices. And underneath that is a credit default swap market. The test is a messy one, but I'm not so willing to say it's been a failure or a loss, or that we can say today that allowing this innovation hasn't been worth it. And because the implication is we ought to outlaw it. And I think more likely the right approach here is let's think about how these troubles existed and can they be cured. We need to think some of these problems are going to get cured by Charles Darwin, because some of the astonishing errors of judgment aren't going to happen again. We're going to move on to other other bonehead mistakes. But some of this can be cured by public action, legislation, regulation, supervision. So let's not get too hasty about declaring what's useful and what's not useful, and let's see if the market plus some judicious public action can in fact produce a more supple, more effective, and more resilient financial market. As for the Fed's bailout, as you said, and I guess we should all thank you very much, and we won't ask for details on how you made your calculation because, you know. But if the answer is there's no free lunch for public intervention, the answer is, yeah, you're right. That's right. But that, again, I don't think you meant that as an argument that said it shouldn't happen or public intervention is never right even if it's costless.
We shouldn't be going on to taxes. What I say, taxpayers are paying, and we shouldn't lose sight of that fact.
Of course. I couldn't agree with you more. Otherwise, if it was free and costless, why, we would just order up endless amounts of it. Of course we need to keep that in mind. And as for Basel II, once again, we need to think seriously, not just about Basel II because that's narrow, right? That's just for banks. We need to think broadly about the financial system. Come back to what I was saying before. Let's take a hard look when we get this, as this settles down. Let's take a look and see what is going to be cured by Charles Darwin and his disciples, and what do we need to act. But here again, I'm not sure that the immediate response is, well, let's just forget about Basel II, because if it had been here, it would have been worse. Because I think you can make a reasonable argument that if it had been here, things would have been better.
Okay, Morris Goldstein.
Is the fund, which after all has a lot of experience in debt reschedulings and the like, going to offer some suggestions in this area? After all, if we go back to sovereign debt restructurings, one of your predecessors did launch an idea, the SDRM, that didn't quite fly, but nevertheless generated, I would say, some useful discussion. Is the fund going to make public some of the options that are out there that go beyond what you've suggested this afternoon?
Okay. Thanks, Morris. Of course, we're thinking in terms of what can be done, because it seems the novelty of the situation calls for innovative thinking about how to address the issues. And for what your statement suggested, that if there are ideas that are already in the public domain, are we going to repeat them? I think we'll try to think in terms of innovative approaches, and I suspect that I'm hopeful that this will prove to be an episode that will point to the usefulness of the fund of basically a multilateral approach and a global approach to these issues. There is a lot of global experience, of course, with various kinds of financial strains and crises, many of them involving home mortgages and others. We'll certainly be trying to be helpful in this regard. As I said earlier, we are members of the Financial Stability Forum's working group, so we are at work in that way. We're doing other things as well, but I'm not suggesting that we have a wonderful list of potential approaches that haven't been thought of elsewhere, but certainly we're thinking about it, and we will not hesitate to communicate with our members if we think we have something useful to say. We don't anticipate taking the lead in this area, because it more likely requires a combination of legal and regulatory action in individual countries. But we'll certainly be trying to be helpful in this regard.
Ernie?
Ernie Prieg, Manufacturers Alliance. If I might move back to some of the other work going on within the IMF, I have a question about work underway to develop guidelines for sovereign wealth funds. I have two questions, one a general one on a specific issue. The general one is the adjective's always voluntary guidelines, but that raises the question of what do you do with the guidelines to bring them into a policy framework. The two options are you can develop multilateral obligations, the IMF, elsewhere, or else it's left to the importing country to incorporate them in some way in the regulatory framework. So my question here is, are you beginning to get into the discussion of what do you do with the voluntary guidelines as you develop them? The specific question is one that I've been caught in the middle on, not in the middle, but I've heard a couple of very, very deep discussions, particularly from U.S. people from the Security Exchange Commission, and that's the issue of reported insider trading. And the concern is there a conflict of interest or a particular problem that's come up in the China case of a sovereign wealth fund is the foreign government, the Chinese government, but they could have access to enormous intelligence sources on what's going on in companies. And of course, for the SEC to do anything, they have to get full cooperation from, again, the Chinese government. And how does one go about that in this context? Certainly, I know they're wringing their hands up in New York. And my question is this particular issue of government sovereign wealth funds and how they deal with allegations of insider trading, are you dealing with this specific issue in your review in the IMF?
Well, thank you for the question. And let me describe where things stand on our work with sovereign wealth funds. This is an area that has attracted enormous attention and both concern on one hand and on the other appreciation for the role that the wealth funds have played in recent months in providing capital and helping to promote the working of financial institutions in distress, etc. It seems to me that this, first of all, we need to keep the whole issue in perspective. They're important, but they do control probably somewhere between 1% and 2% of world financial assets. So they are non-trivial, not anywhere close to being determinate. They've been around a long time and in many forms. And they've, of course, grown rapidly recently, and our own expectation is, given the persistence of imbalances and the way that they are, and the reasons for their recent growth, that we expect that they will continue to grow, at least in absolute terms, perhaps even somewhat as a percentage of total assets, although that's not immediate, that's not necessarily true. There is, given the attention being paid to their functioning now, it seems pretty straightforward that there is a mutual interest on both the side of the investing countries and the recipient countries to arrive at some satisfactory modus vivendi that provides, on the one hand, assurance to the funds that they have access, reasonable access, to the domestic financial markets and international financial markets as well. And, of course, you're reflecting the concerns of recipient countries about the behavior of sovereign wealth funds in their own markets. There are two parallel efforts going on in this context. One is on the side of the OECD, that is working with the recipient countries on issues of guidelines and standards and trying to see if we can reach some kind of harmonized approach. We are working with the sovereign wealth funds to see if we can develop a set of best practices. It seems to me that it's in the mutual interest of both sides for these efforts to be successful and to produce reasonable results. I would suggest, however, that when I listen to the discussion about this, often I hear slogans that may sound appealing, but when you try to make them operational, are less clear. Let me give you an example. You can hear lots of admonitions that the wealth funds should be required to follow only commercial ends and should be admonished to do nothing but pursue returns. Well, what if a wealth fund wants to follow an investment program that is environmentally sound and responsible? Is that permitted? Is that allowable? Is that not? These are more difficult kinds of problems. So I think when we get to any one of these simple-sounding admonitions, when you start to try to talk about them in terms of how do you make this operational, issues of governance, issues of transparency, issues of goals, this is going to turn out to be just a bit more complicated than at the level of slogans. And yet, we all know that both sides have an interest in a reasonable and acceptable outcome. The funds themselves, what we've done, we met with the funds last fall. They agreed. We are circulating a survey among the funds describing their basic practices, and then that will form the basis for another round of discussions with the funds to see if there's a consensus that will emerge with regard to best practices. The OECD is moving along with its discussions. So, frankly, my view is that again, just to repeat for the third time, there's such a clear mutuality of interests here and an acceptable solution that I'm quite hopeful that we will make some real progress. But once again, to repeat also, the more you think about the kind of slogans that get applied to this issue, the more you realize it's not quite as straightforward as some might want.
Jim?
Jim Hoagland, Washington Post. John, if you permit, two questions. The first is that you've laid repeated emphasis here on the multilateral approach to this global credit crisis that we're facing today. I'm wondering if you envision the need for some kind of new international structure, or if you're suggesting that the existing international financial structures need to have some kind of special event or special focus, or exactly what do you mean structurally and procedurally? Second question, I'm quite taken by the image of you shaking your head as these horror tales unfold and asking yourself, what were they thinking? What's your best guess at answering your own question? Is it as predatory and irresponsible as it seems in many news accounts, or were the people on Wall Street thinking something else?
Well, that's a very attractive question, but I'll try to hold myself back. But let's start with the first part. Are we thinking new structures? And say, well, I don't, not necessarily, but I wouldn't want to rule it out. What I was trying to suggest is the IMF exists, a global institution with a constitutional responsibility for promoting global economic and financial stability and progress. And I think that we have a very important and useful role to play here. In addition, there are other institutions in this regard, the FSF, the IOSCO, other more specialized institutions that also have a role. But why I don't, so it doesn't immediately occur to me that what we need are still more institutions. We need to think, it's my opinion, we need to continue to think about how we make use of these institutions more effectively to consider multilateral issues and global issues. But I wouldn't want to say, never say never. Never say never. But think about at the risk of belaboring a point that all people in this room know extremely well, the fund faces, and the global system faces, two elemental challenges. One is that we have, for the first time, something that we can call a global economy, for the first time since before World War I. How do we govern global institutions in a global market? Secondly, we have a global financial market in a way that may never have really existed. Or if it did, it certainly hasn't existed since World War I. And how do we even understand clearly what are issues of sustainability? How should that operate in the face not only of its novelty, its explosive growth, and its structural innovation? So I'll stop here because that's pablum for this group. But then let me turn to your what were they thinking? And it's well, I can't resist this one. You'll all have to go ask the participants what were they thinking. But here again, it's often you hear that it's the lenders, and certainly there are issues about that. I guess given my own background, I tend to look at the housing sector a little bit like when you see a big real estate development that's gone bust, and you look at it and say, what were they thinking? And to me, the answer is, well, it's a developer. If you give them money, they're going to build something. The real question is, who gave them the money? What were they thinking? What were the people who were funding these mortgage brokers who were doing what seemed to be pretty high-risk things? Why didn't the market discipline in funding those activities work right? And here I think we're going to find that it's the innovative structure that not everybody understood. It was this, in the context of this extended period of economic success and stability, that made people too complacent. And so my guess is it's going to be a combination of Charles Darwin and some legal and regulatory action that are going to make sure that this doesn't happen again. And now we just have to think, if it doesn't happen again, what will happen? Thanks.
John, I'd like to revert to one key point you made in your remarks and maybe suggest from that an additional role for the fund. You noted a couple of times pointedly that the substantial rise in world commodity prices, including energy prices, seriously complicate the problem that the world is facing now. Raises the stagflation risk, certainly complicates the tasks for central banks, as you said, makes the inflation risk worrisome as well as the turndown risk. So the rise in commodity prices is a significant piece of this whole picture right now, as you said. The commodity markets are quintessentially global markets, and therefore integral parts of what you just described, global economy.
Exactly.
What is the IMF doing about that problem? What is the IMF doing to try to deal with the problem of rising and problematic commodity prices? There's an oil cartel out there. There are plans to develop a gas cartel. There are all sorts of nonlinearities and market shortcomings in various individual commodity markets. I at least am not aware that that has been a focus of IMF policy attention in the past, but it strikes me that unless the fund addresses that, it's missing a big part of the equation, as you described yourself. And so my question is, what are you thinking about in that context? What could the fund do in that area where no other international institution is constituted in order to help alleviate the global macro problem?
Thanks. That's, of course, an excellent question. Well, let's take it by parts. There's some aspects that, of course, that the fund are beyond the fund's expertise. We're not experts in the oil market itself, in the production of oil or the exploration or the fine details. But in broad macro terms, there are some things that we do think we can see. One relate to an obvious observation. One of the reasons why we've had this strength of commodity price appreciation is the unexpected growth and the intensity of growth, the strength of growth in the emerging economies and their commodity intensiveness, i.e. that for an equal percentage growth in GDP in the emerging markets, the growth in commodity demand is much faster. Now, there are many reasons for that, but one of the reasons is because there has been an incomplete pass-through of increases in world prices to consumers. So naturally, you wouldn't expect, if the consumer is not paying more, for example, at the pump for an increase in world prices, why would you expect them to consume less? So that's going to be one of the questions. Another is, more broadly, is trying to understand ask questions. You can answer questions such as, there's been a big increase in the financial role of commodities, i.e. as a trading vehicle. Many people would like to say that's it. It's those speculators that are driving up prices. Others say, like you implied, is there a problem on the supply side with the cartelization? Is that actually important? These are important issues. As I say, these are of interest to the fund, and we have been working on these to try to understand the macro role and the macro implications. Because, for one, they are going to have a very important impact going forward. So, suffice to say, there's a limit to, as I say, there's a limit to our knowledge and our expertise. But within that, within our expertise, we do think that there are some important questions, and we are asking them. And we have published some of that work, by the way, and we will continue to.
Let me, John, just maybe push you a little bit more on that.
Sure.
I think everything you said so far was good, but I would suggest there might be more there.
Yeah.
In the financial area, which is obviously your expertise, but in the financial area, you are obviously thinking, as indicated throughout these remarks today, about global regulatory processes,
Right.
global best practices, guidelines, international cooperation to reduce or hopefully eliminate market imperfections and coordinate, harmonize regulatory, supervisory practices, and therefore the economic environment within which the financial markets work. Same set of issues clearly arises with commodities.
Mm-hmm.
Think of oil. If we had an international Sherman Act, then we might not have a global oil cartel. Well, if we're going to think about global regulation of financial markets, why don't we think about global regulation of energy markets? Payoff might even be bigger.
An interesting question, one worth asking. Obviously, as you know, that's not likely to be on the agenda for the next month's spring meetings. But for sure, it's a kind of question that's worth asking. But we shouldn't presuppose we know what the right answer is, right? In that you would want to ask, okay, what makes energy, e.g., or copper, different than shoes or some other product? What kind of? In other words, it's not a. It's a question obviously of importance. It's a question worth asking. I have to say, as you probably could tell, my suspicion is if there was more direct pass-through of prices, that you would see the market working better. And my guess is that given the cost of what's going on, that you will see the pass-through with a lag. In other words, the adjustment is going to be there, but it's going to be slower than in the past. And given the slowdown in global growth that we foresee, even in our base case, which is a reasonably benign one, we expect to see some easing of prices. And when you look in the past, there is generally, even in the past, there's been a lag between a slackening of global demand and an easing of prices. But your questions are worthwhile, and ones that we are looking, as I say, we are looking at, because the implications for the macroeconomy are straightforward.
Okay, we're just about to our witching hour. If anybody else has a burning question, we'll have one more. If not, and I don't see any more, I will thank John for being with us, for your candor. Good luck.